Hello everyone and welcome to our yet another very brand new unit where we are going to discuss double entry. And of course, as you all know, double entry is a very important concept of accounting. And you'll all agree with me that it forms the foundation of our career actually as accountants. If you don't know double entry, then really you are not an accountant. So accounting begins with double entry. That is my belief, and it's a very interesting unit where we are going to enjoy this concept in accounting. So of course, you'll find double entry in financial accounting. We have different branches of accounting. We have cost accounting, we have management accounting, we have financial accounting. So for those who seek to proceed and progress in their career in financial accounting, this is the lecture for you. And of course, you'll agree with me that there's a lot of double entry in financial accounting, though you may find some of it in management accounting, but not much of it. So double entry basically is a principle that we use in financial accounting to record transactions. We have seen the other phases. We have seen the very first phase number one, which deals with the recording of transactions in books of accounts. And then of course we looked at the second phase, which is to do with analyzing those transactions. Of course, when we record in source documents like the receipts and vouchers and invoices, we now transfer that information in form of an analysis in what we call the books of prime entry. And in accounting, we believe that the books of prime entry are where these transactions are recorded for the very first time. So ideally, books of accounts will begin in phase number two, where we transfer whatever we have recorded in the source documents into the books of prime entry. Definitely we have appreciated the various books of prime entry, which include of course the day books, the sales day book, the purchases day book, the cash book, the petty cash book, and all those returns day books for sales and purchases. So we've appreciated the accounting there and the concepts there. And then of course in the very previous lecture we have looked at ledger accounting, where we do some kind of summarizing and classification of those transactions. Now when those transactions are recorded in the day books, we now proceed to classify them. So the classification is done in ledgers and accounts. Now the double entry is going to be experienced when you're transferring transactions from the books of prime entry into the ledgers and accounts. So without this knowledge, it means that you may not really do much with those transactions. So in this lecture, I'm going to aim at ensuring that you have the knowledge, okay, you are empowered with the skill of recording these transactions using our double entry system. It is only us accountants. You never find it in medicine. Lawyers will not have this. Engineers will never have this. It is us accountants who have this double entry principle, and we are proud of it. And of course, the reason is that it makes us who we are. It makes us the accountants. So we always confuse them. Those other professionals, we confuse them with this double entry because we know we are the only ones who know this. So straight away into the lecture, we want to understand what is this double entry. So in the first bullet, we are saying that double entry bookkeeping is based on the idea, okay? It is based on the idea that each transaction that has been recorded, each transaction has an equal but opposite effect. Each transaction has an equal but opposite effect. So we believe that every accounting event must be entered in ledger accounts both as a debit and as an equal but opposite credit, okay? We believe that accounting events must be entered in ledger accounts both as a debit and as an equal but opposite credit. We continue the second bullet on the slide by saying that ledger accounts with their debit and credit sides are kept in a way which allows the two-sided nature of every transaction to be recorded. So you find that the way these ledgers, these accounts, we have looked at how they design the format of the account. You have seen that the account has two sides. It has the left hand side which will record the debits, and then the right hand side, which will record the credits. So that is how we maintain, and that's why they call them T accounts. Okay, they are T in nature because they have to permit the two-sided recording of a transaction. So we continue by saying that this is what is known as double entry system of bookkeeping, because every transaction is recorded twice in the accounts. So whenever you find yourself recording this transaction once, just know that you have not completed the recording of the transaction. It is not until when you pass the second entry on the transaction that you will know that you have fully completed the recording of the transaction. So, we continue the following slide by bringing out the rules of double entry. We bring out the rules of double entry. So the very first rule is that increase in an asset, we shall make a debit entry. Okay, if there's an increase in an asset, we shall debit. When you find that your computers are increasing, or this transaction that has taken place has led to increase in computers, or increase in motor vehicles, or increase in receivables, increase in inventories, all those are assets I'm mentioning here. If you find that a certain transaction X has led to an increase in an asset, what you're going to do, you're going to debit. Okay, you're going to debit the asset account. You're going to debit the asset account so that you recognize the increase in the assets. So here we are saying that rule number one, if there is an increase in an asset, we shall make a debit entry. Number two, if there is a decrease in an asset, what we do, we make a credit entry. If you find that the assets like computers have been disposed of, you find that inventories have been disposed of, the building has been disposed of, or you have paid out cash, because you know cash is also an asset, there is a decrease in an asset. So what we do, we pass a credit entry in that particular asset account in order to recognize the decrease in the asset. Number three, we are saying in the rules that increase in a liability, what we do, we make a credit entry. If you find that your liabilities have increased, for example, if you acquire goods on credit, okay, if you acquire goods on credit, that one is going to lead into increase in liability. If you get a loan, for example, your liabilities have increased. So to record the loan, to record those goods that you have been acquired on credit, what you do, you're going to credit that particular liability account to recognize an increase in the liability. Number four, in the rules, we are saying decrease in the liability, we make a debit entry. For example, if you clear your loan, your liabilities have gone down. If you clear the suppliers, those people that have given you goods on credit, your liability has done what? Has gone down. So what you do, you will debit that particular liability account. You credit the loan account, you credit the trade payables account, for the examples I've given above. Number five, we are saying if there is increase in capital or equity, what we do, we make a credit entry. If your capital has increased, if you put more money in the business, in form of capital, then it means that you're going to credit the capital account. Then again, we are saying decrease in capital is going to lead to a debit entry in the capital account. So if there is a decrease in capital, what we do, we debit that particular capital account. Next, we are saying increase in expenses, what do? We shall make a debit entry. So these are rules, they're not supposed to be broken. The rules are like that. So I'm saying if there is an increase in an expense, for example, if your rent has increased, if your transport has increased, if your electricity costs, bills have increased, what you do, you're going to debit that electricity account, the transport account, whichever expense we are talking about, you're going to pass a debit entry in the expense T account. Then finally, if there is an increase in income, what do? We shall make a credit entry. Okay, if there is an increase in income, we are going to make a credit entry. So these are the rules of double entry. Now let us slowly go back, okay, because as I mentioned, this is the foundation. This is you, the accountant. Now, so These are the rules, please. This is your foundation. Leave alone the issue of going for the exam. Leave alone the examination. But this is who you are. You are the accountant. You cannot fail to appreciate, conceptualize, weigh, put on, digest these rules of double entry. So I encourage you to do that as much as possible. Now let us summarize. Let us summarize these rules. So what we are saying is, when you pass a debit entry, either there is an increase in an asset, decrease in a liability, or increase in an expenditure. Okay? When you pass a debit entry, either there is an increase in an asset, decrease in a liability, increase in expense, and maybe what I didn't put here, decrease in capital. Okay? Now, when you pass a credit entry, we are saying a credit entry will do what? A credit entry will decrease an asset, increase a liability, increase income, or increase capital. You can add that one there. You have your notes, you have your pen, and somewhere you're writing on there. You've already downloaded the slide, so you're writing there. All right, we continue. Let's continue. We continue by saying that the basic rule which always has to be observed is that every financial transaction gives rise to two accounting entries. One is a debit and the other is a credit. Okay, one is a debit, the other is a credit. So whenever the accountant is recording a transaction, there will be two entries passed. One is a debit and the other is what? Is a credit. We continue by saying that the total value of the debit entries in the nominal ledger is always equal. Okay? The total value of the debit entries in the nominal ledger is always equal at any one time in the total to the total value of credit entries. So you have to make sure if you pass a debit of 2 million, the corresponding credit is of 2 million. If you pass 10 entries of 2 million, by the way, I need to mention that it is not always that there's a time I was teaching in class and a student, excuse me, sir. Actually, after this lecture, I had talked about equal and opposite entries, because I was saying you pass a debit of 2 million and a credit of 2 million. Those are two equal. So what I did, I passed 10 entries on the debit, totaling to 2 million, and then one entry on the credit, totaling to 2 million. And then this man told me, excuse me, sir, but you told us you pass 1-1. I said, no. That's when I go to know, when I'm explaining this part, I should make the emphasis. So the emphasis is, as long as you have passed a debit entry, be it 20 debit entries and 2 credit entries, the totals on those two must be the same. It's not always that you pass only 1-1 which are equal. No, you can pass actually 2 debit entries of 10 million and then 1 credit entry of 10 million, as long as the debits are equal to the what? Are equal to the credits. All right, we continue. Which account receives the credit entry and which account receives the debit entry depends on the nature of that transaction. Okay? Which account receives the credit entry and which account receives the debit entry depends on the nature of the transaction. So it will depend. We have seen the rules. You know, when you debit, what happens? You know, when you credit, what happens? I'll not go into that again. All right, I continue by presenting now the T accounts. How will the T accounts look like? Let's begin with the T account for the asset. All right. So, as you can see, the T account for the asset, whatever you put on the debit must be increasing the asset account. Okay? And whatever you put on the credit must be decreasing the asset account. Okay? Let's look at now the liability. All right, this is the liability account. This is this debit side, that's the credit side. As I mentioned, always the credit will the debit will always be on the left hand side and the credit will always be on the right hand side. So whatever you put on this side of the liability account is going to decrease it. to be a debit, and whatever you put in the credit side will increase the liability account. All right, capital, the same thing. Whatever you put on the debit of the capital account will decrease it. Whatever you put on the credit side of the capital account will increase our capital account. Next, income account. Whatever you put on the credit, as you can see, there is nothing on the debit. We shall never debit the income account. We shall never, as I told you, there's only one entry you can pass in the income account, and that's the credit entry, which increases the income account. Similarly, with the expenses, what you're going to do, you only pass the debit entry. There is nothing on the credit entry here. There's nothing here. Don't put anything here unless you're closing that account. So for the expense account, whatever you put on the debit will be increasing the expense account. So all in all, that is our discussion. It has been enjoyable, and right now I want you to go back into the notes and see what we have discussed and try to comprehend and put everything together. For now, I will leave you to relax a bit, download the notes, go through, and then when we come back in lecture number 2, we shall talk about journal entries, and then we shall review an exam type question, and then that will be the end for this particular unit. So for now, so I invite you to enroll for our full online financial accounting course. Send me a WhatsApp on 256 786 499326 for details of the course syllabus and the timetable, and enjoy these very, very detailed and interesting financial accounting concepts.